So the government just revealed its ability, let's say, to monetize gold. And what this would do, assuming they revalue it, it would take it up to $20,000, $30,000, $40,000 an ounce. Now, why would they do this? Because it's a very clever way to solve their quote unquote debt crisis. And if you think this is some conspiracy theory or if this is just some wild, crazy idea, it's not. In fact, let's go right over to the Federal Reserve's report they just released. And I don't know, I mean, it's on the internet, so I assume it's available to the public, but it seems like it was something that was just meant for the internal operations of the Federal Reserve. Why do I say that? Because it's an actual manual. That's right. It's a Federal Reserve manual, like something you'd receive if you were just hired there. So let's get into this and really think this through. But this is something that should be taken very, very seriously. And if the likes of Scott Bessent and Donald Trump believe the United States has a debt crisis, this would be a very quick and easy solution that, again, would make gold most likely rip, I say, higher, and possibly overnight. So let's go over to the Federal Reserve. And this is the document I'm referring to that I open to the public. It's right here on the internet, but it doesn't really seem like it's one that was meant for public consumption, let's say. The Financial Accounting Manual for Federal Reserve Banks. And look at the date, very recent, May 2025. Now, May 2025, excuse me. Now, let's go down. We're going to get back. They give an example balance sheet, which is really fascinating. It's 200 pages here. And we're going to get into that example balance sheet in a moment. But before we do, look at how this report starts right here. Section 2-10. They talk about the gold certificate account. Now, before we get into this, let's go over to a Forbes article where they were talking about this. So again, this isn't something that's just, tinfoil hatters are talking about. This is something that it's mainstream. Now, you don't hear it often, but it is definitely within the mainstream because, not only are guys like Luke Gromen talking about it, but it's right here in the Fed documents. But here is an article, Is it time for the U.S. to revalue its gold reserves? Now, they're talking about doing it a little bit different way, just bringing it up to the market value. But as Luke points out, they could take it up to 20,000, 30,000, whatever they wanted to in order to solve this quote-unquote debt crisis. So first off, I want to highlight the fact the U.S., according to them, who knows if it's really there, but they say they have 8,133 tons. Now, I did the math on that for a whiteboard video today. It's right around 260 million ounces. So this article is a little old. I did the math on today's price, roughly call it 3,400. And this equates to about 856, I think it was, $billion worth of gold the United States has on their balance sheet. Okay, got it. Now let's go back to the accounting manual for the Federal Reserve and this 2-1. Now listen to this very carefully, guys. The Secretary of the Treasury, Scott Bessent, is authorized to issue gold certificates. Now, this is just simply kind of a claim on the gold the Treasury owns. So they're not really selling it. I think technically it would still be on their balance sheet, but it's a claim that they would sell to the Federal Reserve, and the Federal Reserve books that as an asset on their balance sheet. And what does the Treasury get in return? Well, the Federal Reserve credits their account, which you guys know is the TGA, the Treasury General Account. It's a liability on the Fed's balance sheet. They credit it for however much the value is of the gold certificates they buy. Let's get back to it. And what I like about this, and which is kind of a head scratcher, because usually they're talking in code and the Fed really doesn't want you to understand or to know what their secret operations are. But here they just come right out and say it. Listen to this. Treasury is authorized to issue gold certificates to the reserve banks, in other words, the Fed, to monetize gold. They're not beating around the bush. They're literally telling you in plain English, explicitly, something they're calling it an accounting manual for the Federal Reserve banks, that they can monetize gold, the gold the Treasury has on its balance sheet. So they specifically say held by the U.S. Department of the Treasury. At any time they can do this. Treasury may reacquire the gold certificates or not. So they talk about the accounts that the Fed has with the Treasury and the Treasury has with the Fed. And this is an accounting gimmick. I mean, let's be honest here. The Treasury is just saying, okay, we'll just make up this paper asset that the Federal Reserve will buy, and that'll go ahead and credit the TGA, and then we can take the money that's in the TGA now, and we can go ahead and use that for whatever we want. In this case, they could use that to effectively buy down the outstanding debt. So what they would do in practice is they would take the money that they now have, the Treasury, and they would wait for the existing treasuries to mature. And they would just pay those treasuries off, the principal or interest, whatever was owed, with the existing balance in the TGA that the Fed credited to them by purchasing these gold certificates that the Treasury just printed, for lack of a better word, out of thin air, that represents a claim on the gold that's probably still an asset on the Treasury's balance sheet, the gold that's in Fort Knox, as an example. And so then what happens is they pay off the existing Treasury holders with new money that didn't exist before. And therefore, they don't have to, those Treasury, or they wouldn't have to have further buyers for Treasury. So they wouldn't have to issue more debt, in other words, to pay off the existing debt. They wouldn't have to roll it over. And that would reduce the outstanding debt of the United States by however many gold certificates the Fed purchased. See, let's get back to the report here. The gold certificates account serves as a medium. Okay, this is where they're talking about the reserve banks. I think this is kind of how the Fed justifies this as this accounting gimmick, as an asset, where if I'm reading this correctly, they're saying, well, the local Federal Reserve banks around the United States could use this as some sort of settlement vehicle, something like that. Okay, sure, right. And then here, the very next 2.2, they talk about the special drawing rights, SDRs. I'm sure you guys have heard about those. But now let's go up. So here it is, plain English. This is not the tinfoil hatter economic theory. This isn't something that, oh, those stupid people on Zero Hedge, yeah, let's get them. They're just making up these theories that have no chance of coming true. No. It's right here. The Fed is telling you this is what they could very easily do. Now, let's go back to the balance sheet, which I thought was interesting. You guys know that and this is an example balance sheet that the Fed uses, obviously, for internal operations. And it's no surprise that, as an example, the assets would be U.S. Treasuries. Hello, we all know that. Mortgage-backed securities, which are somewhere in here. Where do they go? There they are. Mortgage-backed securities, U.S. Treasuries. And this is how the Fed's balance sheet goes from $800 billion, and then they do QE. They buy those treasuries. They buy those mortgage-backed securities, and they monetize the treasuries. That's what they're doing. That's where the phrase monetize the debt comes from. And that's what takes their balance sheet from 800 billion all the way to a peak here in 2022 of almost 9 trillion. Almost 9 trillion. Okay, but and this is the main asset that's on their balance sheet. But look at this example balance sheet. Those bonds, or those treasuries, excuse me, are listed right here. mortgage-backed securities right here. But the very first thing that is, or the very first line item, let's say, on this example balance sheet is not U.S. Treasuries. It's right here, gold certificate, the very first thing. And oddly enough, the second one is special drawing rights, SDRs. This comes before U.S. Treasuries and before mortgage-backed securities. So the punchline here is buying these gold certificates and monetizing the gold the Treasury has on its balance sheet is as legal as doing quantitative easing. I mean, it's right here. It would be very, very simple for them to do this. It's not some complex equation, or it's financial engineering for sure, but it's not complex financial engineering. It's not like we're talking about derivatives or interest rate swaps or any of those things. It's just simply the Treasury selling an asset, a gold-backed asset, to the Federal Reserve, and them crediting their account, and then the Treasury using that those bank reserves to go ahead and reduce their overall debt. Now let's think about how this would impact gold, because what I should have done here is I should have had a chart. Let's see, let's do debt to GDP, because now I have different views than Luke on, kind of this. I don't have any different views on the doability or the government's incentive, or maybe that's not the right way to say it. I definitely agree with him as far as the process and how this could be done. I mean, there's no disputing it. It's right here in the Fed documents. But I don't know the necessity, but that's really not the point. I mean, that's a topic for a completely separate video. What we have to do is we have to look at this through the eyes of Scott Bessent and Donald Trump, who we know are very, very concerned about the debt. And whether I agree with it or not, who cares? This is not what we're talking about. They believe that especially the debt to GDP is at an unsustainable level, and it's only going to get worse, especially if we have higher interest rates or interest rates stay the same, because the interest payment on the debt is going to go higher and higher and higher. That means they have to issue more and more treasuries, more supply of treasuries with possibly less demand. That means that interest rates go up, which makes the interest payment on the debt even higher, and you go into this doom loop where then the only option in their eyes is for the Fed to come in and not just monetize gold, but monetize the debt and to keep interest rates down. And therefore, you could have inflation, that leads to a lot of bad things potentially. So this is the argument. So what guys like Luke will say, and rightfully so, is that if we could just get this debt to GDP down to, let's say, 60 or 70%, then it buys the United States a lot of time. It gives them a lot of runway that they otherwise wouldn't have, in the sense that, historically speaking, for not just the United States, but other countries, this is when you're in the safety zone. This is when you don't really have to worry about foreigners wanting to buy your debt because they see the supply being an issue. This is when the debt is, quote unquote, sustainable, right? Now, again, I don't really agree with the premise here, because we're assuming that supply really drives interest rates. And as you guys know from watching my videos, I don't see any historical precedents for that in the United States. I think it's more so about growth and inflation expectations. Even if the debt to GDP is at 120 or 140, I still think it's about growth and inflation due to the way the monetary system is set up. But like I said, that's a topic for a separate video. So let's think about this. What Luke is saying is absolutely true. If the United States revalued their gold holdings to, let's say, 20,000 an ounce, now all of a sudden it changes the game. Because then the gold that they have on their balance sheet goes from a value of, let's say, 850 billion to, let's say, 5 trillion. Now, it is true that the current debt is 37 trillion. So this would take it down to 32. But what we're not including in that are the knock-on effects that could happen. And this is Luke's base case. So let's see, how would I explain this? Basically, you've got two groups of people. You have whose purchasing power would increase massively. Number one, let's say they revalue at 5 trillion and all of those gold certificates, 5 trillion worth, go onto the Fed's balance sheet. The Treasury in the TGA now has an extra $5 trillion that they use to pay down the debt, right? Well, those debt holders allow that to mature. They're not rolling it over on aggregate. It's not the same people, but on net balance, you're reducing the amount of treasuries that are floating around, and you're replacing that with cash. That's what you're doing. So you have $5 trillion of additional cash that's circulating in the actual economy, chasing goods and services, potentially, or maybe assets, right? But what this likely would do is increase the inflation rate. Now, you guys know that nominal GDP is simply, it's basically growth in inflation. Said another way, it's real GDP plus the inflation rate. That's nominal GDP. So if you get the inflation rate up, what you're likely to see is nominal GDP skyrocket. Okay? So if nominal GDP skyrockets to 40 trillion, even though it's almost all a result of inflation, just prices going up, and if we're able to buy down the debt to 32, that's how you could get us in this range of, let's just say, well, this is 100, but this range of where we were prior to the GFC at 60 or 70, which would be quote unquote sustainable. But you see, that would, just to get 5 trillion, would require a $20,000 gold price. That's why I say, I mean, maybe they don't want to wait for the inflation. Maybe they don't think inflation would happen. Maybe they don't want to wait for these knock-on effects. So if you're going to go ahead and pull the trigger, why take it to 20,000? Why not take it to 30 or 40? Now the question I'm sure becomes, well, George, how on earth would they do this? And this is actually the easy part, because what they do is simply say, we're going to put in a bid, we the government, we're going to put in a bid for 20 grand. So if you're someone that is holding gold and you want to sell it, why would you sell it for less than $20,000 an ounce? The answer is you wouldn't, because you could just sell it to the government and they'll give you $20,000 an ounce. And you say, well, George, where is the government going to get it? They're just going to sell treasuries. And you say, whoa, isn't that going to increase the debt? Not really. In a way, it's going to increase their liabilities, but it's also going to increase their assets, right? Because they're taking on the gold, so that's an offsetting asset to that new liability. So it's not just like selling a treasury where you're just increasing the liabilities, you see? And I would also point out that they probably wouldn't have to buy much, because let's remember, see, I pulled this up. This goes back to the cerveza sickness. Remember this, guys? Remember when the Fed stepped in and started buying corporate debt? Because the liquidity froze up and interest rates were blowing out. In fact, I've got the interest rate spreads right here. So spreads started blowing out, and the Fed steps in, and they didn't buy much. I think they bought maybe, 10 billion, something like that, worth of corporate debt, but that's all they needed to do. And then the market came in and did the rest, because basically the Fed comes out and sets a bid at X price, and the market's like, okay, they're just gonna keep buying. So once it gets up to that price, we're confident that it's not going to go any higher, or the price isn't going to go any higher. So we're willing to step in and buy at this price, because we've basically got a ceiling, and we know that if the price goes above that, the Fed is going to step in and buy. So we've got an automatic hedge. It's the risk reward makes all the sense in the world. So then the market comes in and buys because of that bid that's put in, or that ceiling I guess it's not a ceiling on the price. I guess it would be a floor on the price. I'm sorry, doing this live. So it would be a floor on the price. So if the price goes too low, then the Fed's going to step in and buy. And so if you know if the price gets to here, the Fed's going to step in and buy. Once it gets right here, why are you not buying? Because all you have is upside. That's what I was basically trying to say. That's the problem with going live. It's very authentic, that's for sure. But you do make mistakes. But you guys get the point. Is the Fed didn't have to buy that much in order to get the price to the level they wanted. And therefore, I think it would be the exact same with the price of gold, is they wouldn't have to, well, this is the Fed, but the Treasury wouldn't have to buy that much in order to get that price they want. And then what they do is the Fed, it's basically like doing QE, where the Fed would then buy the gold, their balance sheet would increase, their assets would increase with those gold certificates, and then they would put the money in the TGA, and you guys know the rest of the story. So Luke thinks this would likely create massive inflation because you're increasing the purchasing power of the individuals that had the treasuries because now they have cash, number one. And number two, you're massively increasing the purchasing power of those people who own gold, right? Now they're like Scrooge McDuck, where they're like swimming around in their coins of gold. Woohoo! Yeah, all right. And what are they going to do? Well, many of them will likely go out and buy other things, and therefore you have more purchasing power, more demand chasing the same amount of goods and services. Prices go up. That's kind of the punchline. That's the release valve, right? Because there is no free lunch. Would this reduce the debt to GDP? Probably. Is it very, very easy to do? Is it legal? Absolutely. 100%. It's just the release valve is likely going to be that prices are going to go up in a way that was very consistent with what we saw in 2021 and 2022, when you increased aggregate demand massively, but the amount of stuff stayed the same, or in the case of the cerveza sickness, actually went down. Main takeaway, guys, this is not pie in the sky stuff. This is reality. If you want to fact check me, you can go and just Google Fed Accounting Manual for Federal Reserve Banks, or Financial Accounting Manual for Federal Reserve Banks, May 2025. Look it up for yourself. Look up 2-10. Look at their example balance sheet. Look at the gold reserves, the words they use actually monetizing the Treasury's gold, and just simply connect the dots. This would literally be as easy or as straightforward and as legal as the Fed doing quantitative easing.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers. But physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming. Young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.